3, 2, 1. Welcome to the show.
Alrighty.
Hey, everybody.
Here we are.
All the people.
All the peeps. Hopefully everybody had a great week.
I'm enjoying this little warm spell that we're having. I always used to joke, you're getting old when you talk about the weather.
Yeah.
And man, I'll tell you this, lately it's like been 12 degrees here, and today it's almost like 60.
It's nice out.
Yeah, I hadn't made it outside much, but I'm looking forward to it.
Yeah, it's nice.
What you got for us this week, man?
Okay. Another rough week for the market. Very rough. Kind of typical for a bear market, which is what we're going to talk about quite a lot on the show. But started off the week with a rally and ended the week lower than where we began. So that's typical. Before I get into all that, we had the monthly member webinar last night, and we had a question from there, and I promised to get back to him and do it on the show. So the question was about inverse ETFs that correspond to...
I remember that.
Right. So basically I'm going to point you to two websites, proshares.com. So proshares, spelling is easy.com.
Common spelling.
Common spelling. The other one is Direxion, Direxion.com. So Direxion.com.
Those are good for finding inverse ETFs.
Yes. So inverse is either, so say it's the S&P 500, right? You can do the SH, the ticker symbol is SH. So if you put SH into it, that's a ProShares fund that if the S&P 500 goes down 1%, the SH goes up 1%. So it's 1-for-1 inverse, right? They also have funds that do 2 or 3 times leverage.
Right. That's scary, though.
Scary unless you're on the right side of it.
Yeah,
right?
because it moves fast when it
Real
goes
fast.
down.
Yep.
And to put some context to this for those of you that weren't on the call and while we're talking about that, so each month we do a performance call, sort of a performance slash coaching call for all our members, and we do it kind of in a webinar format where they can kind of ask us questions and everything. And sometimes we'll talk about other kind of vehicles, retirement vehicles, and obviously here on the show we talk about IRAs. And so someone asked, how would we? And this goes for the mutual fund window also. There may be a possibility that we can find something that's equivalent to an inverse.
Possible.
And so what you want to do is have the ability that when a certain sector of the market is going down, you might be able to use that inverse one to take advantage of that.
Right.
And so the topic really was more about being able to not just invest in the index, but to break it down into those sectors. Right. Because as you pointed out on the call, energy and what was the other one?
Financials.
Energy and financials.
And consumer staples.
We're not going to go into the charts on this one, but, if you were in energy, right?
You've been making a killing in 22 in energy.
You crushed the S&P 500, right? In the TSP right now, we don't have that opportunity, but we do if you have an IRA account or a brokerage account. Mutual fund window, maybe though. We don't know.
Possible. We don't know.
All right, let's keep moving.
So what are we going to do this week? We're going to look at market cycles in general, then drill down into a bull market cycle, a bear market cycle. We're going to look at, then we're going to do like basically a real life example of the bull bear cycle in Peloton. If you guys were watching it at all this week, Peloton had a huge week. It was up over 40% for the week. So if you had bought it last Friday, you made a killing this week. But in the big picture, it's a great example of the bull-bear market cycle. So we'll take a look at that. And then the 2-year weekly charts. Okay. So market cycles, what you need to know. This is all from this website right here. I would definitely go and check it out. There's a lot of good info in that site. So just in general, market cycle is a process in which bull markets mature from the beginning to the end and then reverse into a bear market cycle, right? The prices go up, they top, and they come back down. Cycles have been unfolding in comparable fashion since market speculation began, basically since the very beginning of people trading things. While no two market cycles have ever looked identical or had the exact same underlying drivers, they generally exhibited similar characteristics during each portion of the cycle, primarily due to human nature and market psychology. So that's probably the biggest takeaway from the slide. The reason technical analysis works is because of human nature and market psychology. That's what when we draw trend lines and we do all the analysis basically is when the line's coming down, price comes up, hits that line, comes down, comes up, hits it again, comes down. It's because there are sellers and or buyers at those points.
Yeah.
And that's why we keep saying it has nothing to do with, war in the Ukraine or, it
does, but it doesn't.
Right. It
because
does.
We're humans, we react to things outside of, our situation or whatever. This is very, when I first got years ago, when I first, I first started following Jerry with the technical analysis. At first, I had a hard time wrapping my head around it because I didn't think of the market as people.
Yeah.
Right.
Sure, it's companies.
A lot of the narrative is that it's companies,
Yep.
that it's big business, it's all these things. And no, it's people. And so as soon as you can kind of wrap your head around that, that's the same way with pretty much any kind of like analytical, intelligence analysis. I need to get I need a Red Bull or something. Yeah, but why? Why are we able to figure out, what's going on? Because we're pattern driven.
Yep.
That's just the way we are.
Yep.
And so, yeah, it's not hard to wrap your head around once you think of it that
Right.
way. And that's why they're trends and patterns.
Right. And it's not exact, right?
Right.
I mean, any kind of analysis that you do in anything, right? Law
Yeah.
enforcement, military, whatever it is.
The bigger you can make the bigger,
The broader the picture, the more you see the pattern for sure.
more data, everything.
And then
So-
when you drill down, the patterns are still there. They're just not as easy to see or as exact.
Right, exactly. And that's why, we are normally pulling back
Right.
and looking at the big trends and not focusing on this,
Right. Because we can't, right? We get 2 moves a month.
Yeah.
So, yeah. Okay. So the market has 5 cycles, and we're going to go into them. All right. So we start off with the bull market cycle. Okay. This is what sort of a dictionary definition of a bull market cycle looks like. 3 weeks ago, so what was that? The 23rd of January, I think. We did a piece of the show was about the Investopedia definition of bull markets and bear markets. This is much more based around kind of the investor sentiment and what happens during the bull and bear market cycles. So here's what it looks like in general. Okay, we're going to come back to this chart. First, we're going to look at the discovery phase. Okay. So this phase marks the beginning of an emerging bull market. The trend generally goes unnoticed by the majority of market participants, right? There aren't very many market participants at the bottom because obviously the discovery phase is the very, very beginning of a new bull market, which means it's the end of an old bear market. So there's very few people trading anyway. It's during this period when the last bear market officially ends, new bull market begins, but it doesn't become apparent until later in the cycle. So I don't really like the rough percentages that he uses throughout this article, but 25% of the cycle is basically the discovery phase. You're going to have accumulation from smart money, right? So people that are seeing that the bear market is over, we're beginning a new potential bull run, and people that are trying to that know what they're looking at can see it as the beginning of a new bull market, and they're starting to invest.
Yeah, and that's exactly what we're trying to help you all that are listening to this become.
Yeah.
Right? If you look at that smart money investors,
Right.
We like to think of ourselves as smart money investors. We might not be, at the level of some other folks that are driving, big money. But no, it's exactly what you want to be. You want to be one of those folks that recognizes a change in the trend long before they start talking about it on Bloomberg. Right.
Yep, 100%. So the trend starts to emerge, right? It's very gradual. You start seeing, and we talk about this all the time, you start seeing higher highs and higher lows, which is the definition of an uptrend. And then a little bit later in the first part of the discovery phase, you get an initial shakeout, which kind of kicks out the people that didn't have a lot of faith. They call them weaker hands. Didn't have a lot of faith in the initial bull run. So the discovery phase, here's what it is, right? We start to have higher highs and higher lows. Market does a run up, and then has this fall off and that first shakeout, right? And so smart money's buying back here. A trend starts to emerge. You get some momentum coming up, and you get a pretty good move. So this might be, say a 50% gain, and that's a good move. And then it'll roll over because that initial shakeout, and people here are going, nah, it wasn't a real rally. It's going to keep going down because if we've been in this long bear market, and now we're starting a new bull trend. So people are still thinking, hey, what if this is a fake out and we're going to keep going down? That's where that comes from. It's also, if you have been following along any of the Elliott Wave stuff, which we do all the time, you can see that they don't talk anything about Elliott Wave in here, but here's the 1, 2, 3, 4, 5. Right? That's how it works. Okay, so the next phase is momentum. So this phase, the trend draws to an increasingly larger market participation base as awareness spreads, right? So the word starts getting out that the bull market, a new bull market is happening. People start paying attention a little bit. Growing participation and excitement builds, accelerating the trend and creating strong momentum. You start seeing higher highs and higher lows, but also on big volume. This is the wave 3, which is the longest and longest in terms of time and price. They say roughly 35% of the cycle. Momentum definitely builds during that time. Underlying bull market becomes apparent to a broader group of participants. Sentiment feeds a healthy trend. Okay. Early on in the phase, investors are still largely made up of unsophisticated investors, but as the trend matures, an increasingly less informed crowd joins the trend. And then you get, in this section, the first sentiment extreme, right? So attitudes towards the market is healthy and able to sustain a strong trend, and sentiment doesn't become moderately extreme until the end of the phase, right? Which would be the end of the 3 leg for us. And then you get the 4, which is the bear trap. So concerns regarding overvaluation and an ending cycle feed a correction, which is the 4 leg. However, the dip ends with the new round of buyers and provides a base for the next leg of the cycle. So that was the momentum piece, right? We had the shakeout, which was the 2 leg, and then the longest part of the 5 waves is the 3 leg ordinarily, and then the 4 ends up being this thing they call a bear trap, because everybody's like, well, the corrections fed by overvaluation concerns and premature fears that the cycle has ended. So it was a big move. The 1, 2, 3. It was a big move, and now we've rolled over. If you could have drawn the trend line here, it broke the trend line and came down a pretty good chunk, right? That's when people bail, because they're not doing the count. It's all emotionally driven. It's a bear trap. Bear trap meaning you think the market's going to go down, and it only turns around and goes back up higher on you.
And we're going to show the reverse of this cycle,
yeah.
right? Because that's important to remember, because if you're taking away from this that, I should just stay in because it's going to go up. No, that's not the case.
Right.
But what we're showing is that these kind of and you can use this sort of we just talked about it, like you can use that same line in a longer time frame or a shorter time frame. Right. It happens the same way.
Right.
Sometimes it happens faster. Sometimes it happens longer.
Yeah.
Right.
Yeah. You can do it in a day.
Yeah, absolutely.
I mean, you can sit down in front of your computer and watch a stock and buy it at a point that you think is good. It might run up a little bit. As it starts to come down, you're like, oh, should I get in, or should I buy some more, or should I sell what I got?
Right.
Like you can do this whole thing in a day or over 25 years.
Right.
Okay. So the last section of the bull market is the blow off, right? It's the 5th leg. FOMO, everybody's favorite word, right?
Fear of missing out.
The blow off phase, the most violent phase of the bull market, as it speeds ahead with maximum participation, with the least informed everyday investors joining in. Market participants' behavior becomes increasingly irrational, and in the case of bubbles and manias, it becomes highly irrational. Eventually, the trend becomes unsustainable, and typically, in an abrupt fashion, it ends. So the stages and characteristics: duration, they say it's the final 10%. It definitely can be long. The fifth leg isn't usually longer than the three leg. It's usually roughly the same as the one leg, but he's saying it's 10%. There's renewed optimism, right? Renewed because people were freaked out about the four leg, and now prices have turned around and gone higher. So renewed optimism, market participants rebuilding confidence following the last correction leads to new highs in the cycle. This reinforces the bullish market psychology and the notion that the trend is sustainable indefinitely, which goes right to FOMO, the fear of missing out, right? FOMO sets in as the trend accelerates higher. During this period, the least informed market participants, i.e. John Q. Public, join in, and the daily media coverage becomes widespread. So if any of this sounds familiar, it should.
Yeah.
Euphoria, right? At this point, everybody is like, hey, the market it's always goes up. Like, why am I worried about these little dips? The market always goes up. This time is different. The Fed knows what they're doing, or whatever. The wars are always good for stocks. Like
whatever narrative you have to tell yourself.
Yeah.
Right.
Right.
To make you feel like, oh, this will be fine.
Yeah.
Right. And that's what we try to stay away from. Right. We want to make non-emotional, rational decisions based on the data.
Right.
Right.
And so as price continues higher and you watch the cycles, you never know when the top is going to be, but you definitely want to know where you are in the cycle.
You do know at some point when the larger trend has changed.
For sure.
That's pretty easy to see.
After it happens.
Right. Yeah, you have to watch it happen.
Yeah. So like, just because we keep getting this question, this is not market timing.
No,
right?
That's different.
Market timing is trying to guess when the top is going to be.
Yeah.
We want to identify when the top has happened as early as possible.
Right. But you have to wait till it's
happened. But you have to wait till it's happened.
Yeah. And the idea is to save your gains, right? Right. And then what we say is don't lose money.
Right.
And so we want to get out after we've recognized it's not really just recognizing the top or the bottom. It's recognizing there's been a significant change in the trend.
Right.
That's it, right? I mean, you can call that top and bottom, but we've seen the trend change. Why wouldn't we, go
protect against those losses? Yeah,
absolutely. Yeah. Or jump back in.
Right.
Either way.
Right. Either way. The most violent segment of the blow-off phase, as investors' rationality goes out the window to infinity and beyond, price can even double or more in extreme cases in a very short period of time. Smart money exits, right? We're just kind of talking about that. If a lot of money managers exit throughout this cycle, but even as such, many sophisticated hedge fund managers are still found guilty of chasing performance. We get a lot of people, sort of mentality is that I could have made more if I had stayed in. And there's no doubt about that.
Right.
There are definitely times when if you just wrote it out, you would make more than you did if you took your money off the table. Again, I didn't write this. They're saying that's when smart money exits. So take it for what it's worth. Right.
But what we're doing there is managing risk.
Yeah.
That's what it really is called. Right. So I might. Yeah. Smart money doesn't work that way.
No.
Smart money says the trend has changed and I don't want my risk level to increase.
Right. To be honest, what would have happened in the most recent example, right? Everybody knew interest rates were going to go up because inflation was clearly coming, right? When energy, if you're looking at, again, we can't do this in TSP, but if you're looking at the 11 subsectors of the S&P 500 and you saw that chart of the XLE, the energy ETF, breaking out when the S&P was tanking, you would have just moved your holdings in the S&P to the XLE, and you would have kept all those gains in the S&P, and then those gains would have continued into the XLE.
Mm-hmm.
We don't have that option.
Can't do that.
We either are in the stock funds or we're not in the stock funds.
Yeah.
Okay, so that is the bull market cycle, right? At the very top, you got somebody who bought it, and they're holding the bag. Okay, bear market cycle. it's essentially just the opposite, right? Here's what it looks like, and it's only got two. It's got the transition and it's got deflation. So let's just go through that real quick. Transition phase is where a major turning point takes shape in market psychology, right? Not necessarily price. Price is in there, but the reason it's a transition is because market psychology changes. So as the cycles shift from bullish to neutral to bearish, right? There's still optimism that the market will continue to go higher, but skepticism at this point to prevent it from actually going higher. So we all know there's a lot of people out there that are like, hey, market always goes up. I'm going to stay in. It'll come back. Like that whole mentality is still there. Mm-hmm. But in the background, people are selling the rally versus buying the dip. And it's happening now. And so it's this kind of struggle, mental, emotional struggle between I owned it up here, it came down, it came back up, and I almost got my money back, so I'm getting out. Or that's one way of feeling about it, right? Mm-hmm. Or I stayed in, I rode it up, it's almost back to where I was, it's going to new highs, I'm good. Only to have it roll back over. Bear markets are unbelievably frustrating because of that. Yeah. So, okay. Duration lasts a small percentage, roughly 5%. Shot across the bow. So we'll look at that when we go to the chart again. But this is the first major decline following the blow-off phase. It serves as a warning shot marked by a fast and furious sell-off. This breaks the animal spirits, they call it, of the bull market, as collectively market participants begin to become less certain about the future. You get a bull trap in there. It's the rally that follows the first decline off the high, stabilizes market sentiment for the time being, giving investors a false sense of confidence that the sell-off is over. Sell-off is nothing more than a sharp but healthy correction. If that sounds familiar, we're in the middle of that right now. We are in the middle of a bull trap right now.
Yeah.
I mean, I don't know what's going to happen tomorrow. Mm-hmm. But if you were watching the market this week at all, you got stuck. If you bought on Monday, by Friday, Monday, Tuesday, Wednesday, I think the market was like way higher. Thursday, Friday came crashing back down at the down trend line, mm-hmm. and it sucks you in and then pushes it back down. It's what happens in a
classic
bear market.
Bull trap.
Yeah. Lower high, so buying pressure fades as skepticism leads to selling. Market begins to behave differently than it had after prior corrections by stalling and creating a major lower high. So that's what happens. The buying pressure fades, and skepticism leads to selling. So the market is behaving differently than it did in the prior correction. And we're going to get to that at the very end. This idea of support and resistance at the 20-week exponential moving average line. So you get a major turning point in market psychology eventually as price continues down. There is remaining optimism that the market will continue higher, but enough skepticism at this juncture to prevent it from doing so. And then you get a breakdown. Confirmation of a top here where the prior low from the shot across the bow is broken. So you get a lower low. This morphs into the most damaging portion of the cycle as a large reversal of fortune begins to pick up momentum. So in the case where we are right now, a couple of weeks ago, we had, January, the market tanked, right? And then we hit a little bit above 4,200, I think, and then recovered really quick on one day and then has moved up. If we close below, I'll stay with if. If we close below that intraday 4,200 number, that's where they're talking about right there. That's the breakdown. Confirmation of a top starts when the prior low from the shot across the bow. So January basically is the shot across the bow in this example, right? Okay. So transition. Here's what it looks like. If January, if the January high was the top of the 5 wave, then January we came down, we had a run back up, if we get below that, like we said, that 4,200 level, then the market keeps going down. Right? That's what they're talking about. Okay, and then you get the fear and capitulation. That's in the next one. So okay, deflation. Nothing more than the market moving in reverse, right? It's the exact same thing as what happened in a bull market, where each time the market comes down, hits a support level and moves on to new highs. In a bear market, it comes up, hits what is now a resistance level, and keeps going down to new lows. But it typically unfolds much faster than a bull market. A bear market happens much faster than a bull market does. So he's saying roughly 25% of the total cycle, but it can vary greatly as the end of the cycle can last years. The purging of excess is built up during the bullish phase is the whole point of this. Fear and capitulation. In this stage, crowd psychology clearly changes as market participants recognize that the bull market is over. They did not recognize it when the trend changed. They're recognizing it now that they've lost half the value of their account. As losses continue to mount, sellers...
That has to sound familiar to folks that watch our show and listen to us.
Yeah.
I hope it does. And if you're new to our show, then understand that rather than just fly right by that part, I wasn't going to let it go by where, when Jerry's talking about you're at this point where you've lost, 30, 40, 50% of your retirement account. And then you're stuck in this position of like, well, you're almost frozen in fear of what to do because I've lost so much. Do I get out and just kind of take that? Or do I hope? I keep praying and I hope, right? I call that hope is not a strategy, right? It's what we're trying to educate and to kind of put out there for folks that watch our show and are members of our site is when we're talking about earlier on in that process where it talked about people who got out when we saw the trend change. That's where we want to be, right? We don't want to take 30, 40, 50% losses. Right. We just don't. We don't want to take anything more than maybe 5 or 10%. Right. Yeah. That's our goal. You're going to take losses.
Yeah, because it's by definition we're not trying to time the market.
Right.
We're trying to recognize when the trend has changed. So you're by definition you're going to take some losses.
And if you followed us long enough, you've seen the charts where we've shown going back well over 20 years and those large market declines, we've been out. Yep. And Jerry's been doing this a long time, long enough that we remember what it was like in the early 2000s and all those times where we took those huge 40, 50%, people lost half their retirement, right? Yep. And we just don't want to be there. And so I didn't want to fly past that without
No. We're going to come back to it, that concept again. This often leads to panic selling and capitulation. Right, that's kind of what Conan was talking about. Like if you're paralyzed with fear and you're like, I've already lost half my money, I can't afford to lose any more of it, and you sell. It's capitulation. That's what that is. You've thrown the towel in, and it happens at Fibonacci retracement levels, which is the beauty of Fibonacci numbers. 50% is not a Fibonacci number, but a lot of times the market comes down 50% and turns right back up. Bottom fishing. So after significant damage, investors seeking value look for a bottom, but rallies quickly fail. Perhaps that something like this week, right? People think the market has come down and they're trying to bottom fish, but the rallies fail. The battle between value buyers and residual sellers keeps the market bouncing along to lower and lower prices, so lower highs and lower lows. Despair is the end of the bear market. So disgust reigns supreme as losses reach a maximum. Residual selling dries up, right? Everybody's sold. There's nobody selling. Market participants play the blame game here, looking for a culprit, right? It's not usually each other. It's usually the Fed or some government policy or whatever, some reason. War with Ukraine. I mean, who knows? There's some reason, some culprit. The period can be over relatively short, or it can last several years before leading to a new discovery phase, which, again, was the beginning of a new bull market. So this is what it kind of looks like, right? You get below that shot across the bow, and the market tanks. And then people in here, okay, we must have hit a low by now, right? We must have hit a low. I'm going to pile in. Market comes up, rolls over, people are bottom fishing, new lows, a new rally attempt, new lows, new rally attempt, new lows. Forget it, I'm out. If I own it, I'm going to keep it until it goes to zero. I don't care. I've sold or I'm selling now, but I don't even want to hear about the stock market anymore. The whole thing sucks. I'm going to go to a baseball game or whatever. I'm not doing the stock market anymore.
Yeah.
That's the bottom.
Yeah. Despair. End of the bear.
End of the bear is despair. And there's plenty of stories about people jumping out of buildings on Wall Street.
Yeah.
It's true. It doesn't happen very often, fortunately,
Right.
but it's true. Okay. So what would this look like in real life? CNBC talked.
I love this chart.
Yeah.
I don't love what it's happened. I don't love that it went down like that, but this is a great learning point.
This is a great chart. It is.
So if you dozed off there for a second, come back.
Yeah, come on back. This is good. This is real life. So CNBC, this morning, I'm listening to CNBC, Friday morning, right? It's talking about what a great week Peloton had. Okay, it was on track. As of this morning, it was on track to make a 45% gain this week, right? But which is true, it did. Made a. By the end of the day, it was a 40.61% gain for the week. So again, someone who okay, a lot of good learning points here. So I have my notes, and I'm going to try to stay with them. Someone who bought Peloton, somebody bought it up here over $170 a share, right? Somebody sold it at 170, and somebody bought it at over 170. If you owned Peloton at 170, how much did this week's 45% gain do to the value of your account? Right? CNBC is like, woohoo, 45% gain right there. That's great. Like I said, if you owned it, if you bought it last week, you bought it down there, you almost, you made almost 50% on your money in a week. That's awesome.
Yep.
However, if you had bought it, if you were the person holding the bag, that 45% move this week didn't do anything for you.
Yeah, even if you're looking back at that kind of, the June, July, August kind of time frame there, right? Am I reading that right? I don't have my glasses on.
Yeah.
Yeah, that time frame there and that other kind of rally there and it back down again.
Yeah.
You're
talking about this.
Yeah, exactly.
Yeah.
So.
Yep. Let me just continue on.
I'm not going to sidetrack you.
Yeah. No. So, if you own Peloton at 170, okay, this 45% gain didn't do much for you. If you had, let's say, $10,000 worth of Peloton at 170, okay, by the end of last week, your account was worth $1,500. It was an 85% drawdown. By the end of this week, so you had $1,500 down here. By the end of this week, that 40.61% made your $1,500 worth $2,109. Okay. So a lot of times people are don't understand the difference between shares. Like, isn't it better that I own a bunch of shares and I buy the shares cheap and all that, right? Again, if you could have bought Peloton last week at $25, you'd have made a killing, right? Now it's whatever, $35.
Yeah, if you bought $10,000 worth of it last week,
you made a killing.
Great. Yeah.
If you had bought it back when it was 170, it doesn't matter how many shares you have in anywhere in here. It's if you have $10,000 worth of it at a certain price, and it comes down,
Yeah, and to put that in perspective for us, so let's say that that's our TSP account.
Yeah.
Right. Let's just say that's our TSP account, and this has happened several times.
Yeah.
I don't know about 85%, but
so I sort of have that. So this is a real life bull bear cycle, right? It happens in individual stocks as well as the overall market. When the 2000 tech bubble collapsed, right? For anybody who was around, which I'm sure most of us were around for that tech bubble collapse, the NASDAQ lost 78% of its value. So the NASDAQ has been crushing it, right, for the past years and years. But back in 2000, it lost 78% of its value. So a bear market is defined as a 20% drawdown, right? We talked about that on the show 3 weeks ago. So from the top here in 170 to a bear market is 136. So just multiply 170 times 0.8 and you get 136. So here we are at 136. Does hitting the technical definition of a bear market mean anything? It certainly does not mean that the collapse is necessarily over, because right there is where we were officially in a bear market on Peloton. All right. So if we do a little analysis of the chart, all right, in terms of the Elliott wave, I mean, this chart looks exactly like the bull bear cycle. If you put those two cycle charts together from the the site that we're looking at, right? This is what it is. So in terms of Elliott wave, right? This was the IPO of Peloton. You got a 1, ABC for 2, nice 3, an ABC for 4, and a 5. Right? And then we have this sideways consolidation. Then on the downside, you got ABC for A, B, C.
Yeah. And
if you did the Fibonacci extensions of all this, I'm 100% sure that you'd get the 1.618. If you did this one and you did that one, I haven't done it, but I would bet money this is 1.618 times the length of wave 1. The stuff just works. Okay, so that's sort of the Elliott wave look at it. What if you did trendline analysis? So if we did a trend line, I mean, if you had bought Peloton back here, I'm going to talk about this in a second, but if you had bought Peloton back here and you rode this trend line up, that week should have spooked you.
Yep.
Because it's outside of that channel right there. Mm-hmm. So that week, certainly I would have gotten out that week. The following week put us in a bear market, right? Because we went through the 136 level. It came down to the prior low. So people are like, nope, that's got to be the low. Several weeks of buying, only to have the market roll over to new lower lows, right? And it continues, pretty much exactly like the charts that we were showing, right?
Yeah, and there are fundamental factors that caused all this, right?
Sure.
There are things that happened in the company and the economy, and a consumer demand. All of those things absolutely played a part in that, right?
Yeah.
And we do look at those things, right?
Sure, 100%. I mean, this is Peloton, so we're talking. Right. It was the ultimate COVID play.
Yeah, right? And so it's not that we disregard those things. It's just at the end of the day, as Jerry points out a lot, all of that is built in there, right? And so all we really have to do, it's nice to know why. If you're doing individual stocks, absolutely, it's nice to know why.
Sure.
Right? It's not practical to do this with large indexes like the S&P 500 that we basically have to deal with in the TSP. So when we're doing these examples, these are good takeaways. Just don't forget the fact that we don't have the capability of understanding the fundamentals of 500 different companies.
It's very tough
to be able to do that, even a sector. But I think the real takeaway here, though, is that if you go back to what Jerry just drew with that trend line, even if that's all you did, right, was draw a nice, simple, decent trend line. Let's say you bought into Peloton because everybody told you it was skyrocketing, it's doing great, and you thought to yourself, okay, I see this trend, I'm just going to draw that line, right, all the way up here, and then wait and see what happens, right? And then when you saw that massive change in trend, if you just said, oh, big trend, change them out. Yeah. Forget about all the noise, forget about everybody else. Yeah. Think about how well you would have done.
Yeah.
Right?
So the Elliott wave cycle of it, right? Actually, there's a couple things I want to point out here, but the Elliott wave cycle of it, if you could have seen, here's the 1, ABC for 2, it's big run up for 3, ABC for 4 that took us back down because this trend line is connecting all these bottoms, and it's not a coincidence that the 4 ended at that trend line. Mm-hmm. And then we had a big blow off top. Then you got several weeks of crazy price movement, right? Crazy, huge price swings, huge. But once we got to this week right here, once we got to that week right there, that close at, where were we, 140. That was absolutely the sell signal, because you knew, if you had known, that we were in this, we completed a 5-leg, we had a whole bunch of high volume price movement churning, and then a breakdown. There's nothing else you could possibly need to see in terms of technical analysis. I mean, you might say, well, that the earnings were great and COVID's still going on and people still need to bike in their house and like all these fundamental things. But the price chart is telling you that the stock is going to collapse.
Absolutely. It's telling you as bright as day,
Yep.
It's not a time to be here.
Yeah. It doesn't mean it will necessarily drop 85%, right?
No,
but there's no reason to accept the risk.
That's a good point to make out. Like, we're not telling you that we would have assumed it's going to go down 85%. We would have just known it's time to get out for whatever reason. Why?
Price is telling you to get out. That's all.
Yeah, and that's how we play the game. We're like, I don't know. The chart's telling me to get out. I'm getting out, right? And if you guys follow our alerts, if you're a member, like that's normally what the analysis and explanation that Jerry gives for the alerts when they come out is generally giving you exactly why. Like, all the data points say get out or get in, and that's what we're going to do. And then if the trend changes, that's fine. We can get right back in.
Get back in or whatever.
Either way.
Yep. Okay, last couple things. Support and resistance. So just like we showed the trend line, right? That trend line is support. It acted as support all the way along through here. And then the third leg blew right out of it, right? But then the 4 leg brought it back to that same support level. That support level got broken right there. Okay, so now the trend changed. So we had the initial move down, right? It's ABC move down. And then we had the recovery rally. So if you connected the tops in here and drew that trend line, like there you go. Now that's what over here was support, right? This was support. This is resistance. So it works, the support resistance lines, that's kind of how they work. The last thing I wanted to point out about this is, only because I think it's kind of interesting. So at the top of the one, it was a little bit below $40 a share. $40, couldn't get to $40 on that attempt in April of 2020. And then in May, we had a huge breakout and it went above $40. That was absolutely the time to buy it. Really big relative, volume relative to the volume back here, right? This was huge volume right there. Absolutely the time to get in. And everybody's like, of course, the gyms are all closed. People still want to work out. Peloton's given us this ability to do that. Clear, huge breakout. The cycle does its thing, comes back down, hit almost back to the absolute low, but basically back to the IPO price, right? $25 a share. And then this week, I think was kind of interesting. It was a huge week and all that, but it got up to $40 a share.
Right.
And then rolled over.
Yeah.
Now, I'm not saying Peloton's going lower from here. I just think it's kind of ironic that it hit that same, that $40 line is resistance now.
But could we be getting to a point, going back to your cycles, right? Could we be getting to a point where the despair is at the end of the bear, right? And so it kind of plays out in that fashion right there, and it kind of at some point turns back into a bull, some version of, because again, Peloton hasn't been around that long. So as we, the years go by, we'll be able to pull back and see, oh, that wasn't a massive change in the 20-year time span, right? Who knows?
Yeah.
Right?
Well, but we didn't talk about this, but the fundamental reason why this happened this week is because there was all this talk about Peloton being bought out.
Yeah, that's where I was going with that, is to say that, like, investors got excited. What if Amazon buys these guys? Yep. What if someone, an entity comes in with a lot of cash that can can absorb this, and what they can do is give them legs for years, decades, right? Then what you'd want to do is to, pay attention to those fundamentals, the information you're getting, and sharply watch the chart
the price, yep.
and see when that trend changes. And maybe if you miss that on this time of Peloton, maybe it doesn't go to the same highs that we have in here.
Right.
Who knows? Who knows where the stability level is? The point is again, there's an opportunity here.
Yeah,
potentially,
sure.
right?
Yeah, 100%.
Or the business closes and nobody can ride their bikes anymore. I don't know.
Right.
Right?
Yeah.
I mean, we've got one down the hall in the
possible.
office that we rent. There's a Peloton bicycle and a treadmill.
Yeah.
And they're cool.
Yeah.
But does it turn into a piece of junk in 5 years? Who knows? You don't know. And so that's not the way you'd want to make decisions on when you're in or out of that stock.
Right.
It's based on that. You'd want to make it, we think, based on technical analysis.
The other thing that's very tough right now, Peloton was up 40.61% this week. So if you've been looking at it, if you're looking at it at 50, and you've been watching it kind of trickle lower, because it's, since, November, it's basically been trickling lower. We haven't had these big, huge moves down, right? It's been kind of dribbling lower. And that is an indication of people starting to throw in the towel. There aren't that many sellers anymore. And we're back to basically the IPO price. So there are people looking at it for sure. But now, this week, it's up 40%. Like, who's gonna buy it now? Because now it looks like it's expensive again, right? Right. So this bear market stuff is very tough.
Yeah, it is.
Very tough.
That's why we're talking about it.
All right. TSP fund charts.
Bada bing. Here we
So
are.
again, if you are a TSP person and you're not into RIAs and mutual fund windows and brokerage accounts, basically this is the best chart you can look at. This is the 2-year weekly chart. So each one of these vertical lines represents 1 week of price. The blue line is a 20-week exponential moving average line. So here's the bottom after COVID. Once we got above that blue line, we stayed there. And every time we came down and tested that blue line, every single time, we went on to new highs. Every time. Until that week. Okay? A change in the trend, the definition of a change in the trend is not a break in the trend line. It's a lower high and a lower low. So technically, right now, price would have to come down below, because here was that 4,200 number we were talking about. If price gets down here below that, now you have a lower high, because here was your first high. Now you have a lower high here, and now you have a lower low here. So now you can connect that channel, and the trend has officially changed. So you could wait until that happens if you want. Or you can look at it and say, okay, every single time we got support at that 20-week exponential moving average line, and then it failed right here, and now we've had 2 consecutive weeks where we attempted to get back above that level and failed, right? This is not a time that I want to be in the stock funds, or at least the C fund, right? I want to be in the C fund when it's riding up along that 20-week exponential moving average line, not when it can't get above it. The 20-week exponential moving average line is now resistance. It's no longer support. So if price continues lower, the line will roll over, and every time price comes up to hit it, it does like that until we get, so it comes down
Till we get above it.
till we get a lower or higher low and a higher high. And then now we'll be in a new uptrend. But there's no indication at all that that's happening anytime soon on this 2-year weekly chart. Okay. S fund. Basically same kind of thing, right? It was riding all the way along that 20-week exponential moving average line until that week right there. And then we get all this resistance every time it hits it. I mean, all the way into this week. Right? Absolutely no reason on a weekly basis to be in the S fund. iFund, we've been talking about it. It's held up the best, right? It hasn't collapsed as much as the CNS fund because it's not as exposed to tech as the C and the S fund is, but closed below that 20-week moving average line here, and for the past 3 weeks, tried to get back above it but can't. So the bottom line is until stock funds can get back above their 20-week moving average line, that line acts as resistance instead of support, and prices continue lower. F fund has been a disaster, but the Fed told us up front that it was going to be a disaster. So, and if you didn't believe it, that was the week you should have really started to believe it. We talked about lower highs for a long time. And then when we got, I don't know, back here somewhere, we got a lower low, and that was pretty much the end of the, if you had any possible hope for the F fund, it's in a serious downtrend right now on a 2-year weekly chart. Okay.
Questions?
That's it. So
a lot of good info in there, man.
Yeah, I thought so.
Yeah, I really liked that. I mean, I like the way that whoever the fellow was or person that put that together. We gave him credit down there in the bottom, but I don't remember who it is. But yeah, I mean, that's a great kind of summary of how all this works, and I hope people get a good takeaway from that.
Yeah. The thing, like, hopefully people look at it and do some self-reflecting about how do I feel about where I am. Do I understand the market cycle? Yep. How do I feel about where I'm at?
So hopefully you'll self-reflect and you'll catch yourself in those moments,
right,
where you go, okay, we're here in this part. I don't need to look at it that way, right? I need to take the emotion out of it.
Yeah, that's the biggest thing. Take the emotion out for sure.
Yeah, hopefully you guys got something good out of this. If you did, share it with your friends. Let us know. I got poked at the other day because I didn't personally get poked at, but someone on our YouTube channel posted that sometimes we are a little slow in responding to comments on the YouTube channel, and they were absolutely right, because we tend to see it in social media faster than we do in YouTube, but we're going to try to get better at it. So that's the takeaway. If you were the person that kind of dinged us on that, we'll do our best. But always, if you shoot us an email, or if you're in our public Facebook group, or if you're a member in a private Facebook group, we do our best to kind of get back to you and give you some feedback. Yeah.
We don't have a huge organization behind us to help us running the show and all.
I don't know where they're at.
There's no Joe Rogan team here, right?
No, quite certainly
Gary
not.
Vee, his team isn't helping us out here. So.
Yeah, absolutely not. The other thing is that at the end of the day, if you do ask us something that's really personal, like what should I do,
right,
and we're not going to be able to answer that, because it's just we don't know your personal circumstances, and we're not in this capacity being financial advisors. Right. We're not going to do that. So
again, though, the point, so for the people that aren't members that are watching this, I mean, we got out of the stock funds on January 6th.
Yeah.
We got in 50% for a couple days in there when there was a market bounce, but for the most part, we've been in the G fund since January 6th, because we're looking at the count, and we're now. Again, if you remember, you'll know what I'm talking about, because I haven't done the Elliott wave count in a couple of weeks. Maybe I'll do it next week. My personal opinion, if I put on my crystal ball hat, I think we are...
It's dangerous.
Yeah, I know. My plan A, let's put it that way. Yeah. My plan A is that we are in a four-leg, a correction.
Mm-hmm.
It's going to be painful, right? But I think my plan A is that we are in a four-leg, a corrective leg, and we go on to new highs by the end of the year.
Yeah. Yeah, and I think a lot of people that are in our, looking at the technicals, there's a lot of discussion about this, and most of it is in alignment with that, somewhere in there, right? Meaning we're not going the other way yet.
Not yet.
Not yet. That is the important part.
Not yet.
All right, guys, hope you enjoyed it. We are going to take a much-needed break this weekend, and hope you do too. Enjoy your week.
Have a good weekend.
Talk to you later, and we're out.